Join us right now to talk about today's market sell-off and the big Goldman Sachs call on the U.S. economy. Quincy Krosby is chief market strategist at Prudential Financial. Lindsey Piegza, chief economist at Stifel, is also with us. I want to go to Quincy first. Quincy, good morning to you. You saw this Goldman Sachs report saying this trade war is actually bad for the United States. You buy it?
Well, until there's an actual very clear truce, it creates a lot of uncertainty, as we already know, and whether or not this continues, capital expenditures, for example, does it bleed into hiring expectations? That's the main worry, is that suddenly companies, if this continues, begin to not just not hire, but begin to lay people off. Yeah, it is a concern if this continues, and if it also deepens into Europe, for example, with tariffs there.
To the extent that you're gambling it is going to continue, what are you doing about it?
Well, you want to have a portfolio that, is as balanced as possible, but quality, companies with excellent cash flow, with dividends, and you also want to hedge it. You want to have treasuries in your portfolio. You want to have some gold. You want to have REITs and utilities, the consummate bond surrogates if yields continue to be pressured to the downside.
At the rate we're going, treasuries are going to have negative yields. You think that's a good idea?
Well, we don't know. I mean, remember Janet Yellen was asked, will you ever resort to negative interest rates in the U.S.? And her answer was, we'll see how it works in other countries. So that would be the Eurozone and that would be Japan. Interesting that the Eurozone is probably going to introduce more of it come September. It would be a shock for the U.S., but, like everything else, everything becomes normal if you do it long enough. And we certainly are looking at quantitative easing again. That's become normal. So I suppose negative interest rates at some point would become normal.
Hey, Lindsey,
not good. Right.
But Lindsey, I was going to say a big story in the Wall Street Journal this morning talking about volatility, not just in the equity market, but pretty much across the board, which really raises the question, sort of, is there a safe haven anywhere right now?
Well, it doesn't appear that there is. When you look at currencies, commodities, equities, it's a risk-off trading environment at this point. And this is simply going to compound the pressure on the Fed to take action at the upcoming September meeting. Remember, in July, they told us that if we continue to see the risks weigh on the outlook, they will act as appropriate. And arguably, the risks are higher at this point than they were last month. When we look at what's happening overseas, we see confidence waning in Italy, manufacturing data deteriorating in Germany, the latest GDP read in the UK showing the first contraction in years. And of course, we don't have to just look overseas. When we look at home, we see manufacturing data really very much under pressure as a result of deteriorating trade conditions, home sales turning negative for more than a year. We do see this compounding pressure both on the international stage and on the domestic stage, weighing on markets, which will by extension weigh on the Fed to take action in September.
So, Lindsey, the Fed's going to cut likely, and they may cut again after that. The question is, will it matter? Will it work?
Well, I do think the fact that they stepped up and they took preemptive action added a bit of confidence to the market. But that level of confidence was retreated after the Fed said, well, this is just a mid-cycle recalibration, as opposed to taking a stronger stance saying we're here, we're ready to engage in a longer period of lower rates going forward. So it was almost as if they were adding support and then taking it away at the same time. So I do think that if they go again in September, they're going to have to back it up with rhetoric saying, yes, we are willing to engage in further rate cuts from here, suggesting that this is more of an end cycle scenario as opposed to mid-cycle support.